Hello there, I'm Ryan, and if you're watching this, you're probably taking Accounting 375 with me at some point over the course of your educational career. Today, I will be walking through assignment problem 310 from the Byrd Chen Textbook, and that would be the 2024-2025 most current edition, at least at the time of recording, most current edition of the Byrd Chen Textbook. So, welcome. So what you should be able to see before you is on the left, of course, we're going to have a template that I've set up in which I can answer the problem in sort of a streamlined fashion. On the right, we have the problem directly from the Pearson e-textbook. I wish there was a better way to go about doing this. It's a little clunky. You may have to zoom in. I'm not going to spend a ton of time on post-production for a video like this. It takes me long enough to do to begin with, but hopefully this will provide you with enough guidance. Look, you guys should all have, hopefully if you are, like I said, taking this course, you've got an e-version of the Byrd Chen, so you should be able to go and reference it as I go through the problem with you. In addition to that, you will also have the solutions. They should be posted on your D2L website. Okay, why don't we walk through this thing? So what I'll start off by doing is just doing a little bit of a chit chat surrounding the narrative of the problem here. What I always like to do with a problem before I attempt the full problem is to take a look at what the required is. That gives me a little bit of context before I jump into doing the major problem. As I'm reading through the problem narrative at that point, I know what the required is already, so I already have some context. So if I jump to the required here, it is determine Matei's 2024 employment income and show all calculations. Great. I know that I'm doing an employment income calculation here. That means if I encounter any other type of income, be it some sort of taxable capital gain or like a Div C deduction or something like that, it's not going to be relevant because this question asks for employment income. So let's just tackle that, right? So I'm not going to read through every single one of these points right now and read through the narrative. You can do that on your own, but what I'll do is do my best to basically read through the narrative and then address each one of the issues as they come up. And then I can take the numbers and I can place the numbers into the template that I have prepared meticulously. All right, so let's give it a shot here. So we have Mr. Matei Novak has been employed by Apex Retailers for a number of years. Apex is a CCPC, Canadian Controlled Private Corporation. The company carries on a business of selling children's clothing throughout the retail outlets. Their retail outlets in Edmonton, Alberta. Super. Matei's salary in 2024 was 120 grand. And then it says that Apex here withholds the following amounts from his earnings. All right. Of course, important to distinguish here, all amounts withheld from earnings are actually amounts that Matei is paying basically himself, right? It comes out of and reduces his gross salary. Now, we all know, hopefully, that gross salary is what's required to be included in income per the Income Tax Act. These deductions here aren't really that. These are what we call source deductions, which are amounts that are withheld by the employer and remitted on behalf of the employee. So while technically they are paid and remitted by the employer, these are amounts that will reduce the amount of money that Matei gets. Not necessarily his income, but they will reduce his money. Some of them may affect his income, but always remember that there's sort of two worlds that we're dealing with. There's what happens with the money, and then there's what happens with income for tax purposes. And those are usually two pretty different things. Sometimes there's some overlap, and sometimes they're just not related. As we can see here, the amount of money that this guy's going to end up with at the end of the year is not necessarily reflective of his income for tax purposes. And we are charged with determining his employment income. So let's do that. We've got a salary of 120 grand, and then it talks about withholding the following amounts. I'm just going to address these things one by one as I go through and make additions and adjustments as necessary in my little template. So let's check out my template. Here it is on the right here. So the first thing that we have to deal with is, of course, his salary. So let's just make that readable. So the salary is 120 grand, and of course, gross salary is meant to be included in income. So I'm going to go ahead and include it in income. There's many things here that I've sort of pre-populated to make my life a little bit easier. So the salary, and then I'm punching in 120,000 bucks over to our right here, and that's the first little piece of the puzzle. Okay, 120,000 must be included in his income. Next up, I'm going to address each one of the various source deductions that's been taken from this guy over the years. So first up, I take a look at his provincial and income tax. Now, that is not anything that he can use to reduce his income. yes, he pays tax out of the income that he earns over the year, but that is not a deduction from his income. Tax is calculated based on this employee's gross income. So these are just estimates of what this guy's taxes payable are going to be that are withheld and then remitted on his behalf by the employer. So in this case, the federal and provincial income tax does not affect his income. Now, what I'm going to do is make sure that I address each one of these things. When there's an amount that I don't include, I'm going to highlight it down below here. So what I will do is simply reveal this, which is federal income tax. It should say federal and provincial tax. Both of these things are not deductible from this employee's income or any employee's income. They aren't deductions. Income tax is not a deduction for tax purposes. It's just you can't reduce your income by deducting your income tax. Okay. Next up, there's EI premiums and CPP contributions. Neither one of these things is deductible, right? Despite the fact that they're deducted from his money that he's earning, right? They are withheld by the employer and remitted on his behalf. They're not deductible from his income, right? There's a stark difference there. So I again will highlight what I've got down here, which is the employee CPP and EI contributions not deductible from income. Ultimately, they become non-refundable tax credits. That should be review for you from any previous accounting course or tax course, I should say, that you would have taken. And these are non-refundable tax credits. These will reduce taxes payable, but they won't affect his employment income at all. So please don't make these as deductions. Next up, I have PHSP, Private Health Services Plan, I suppose, the employee portion. So the employee here, what's withheld from Mate's salary is $900 over the course of the year, and it's remitted to a private health insurer. Right now, this is again not deductible from his income. Remember, always ask yourself a question: if the employee is paying amounts, is that deductible? That's what you have to determine. If an employee is receiving something, you have to determine if it's taxable. In this case, this guy is paying what? $900 over the course of the year, and you have to ask yourself a question: is that deductible? But of course, or not, of course, necessarily, but this is not a deduction from income. Okay, this is just an amount that he has chosen to in order to insure himself. And so it's basically considered a personal expenditure, in which case it's not deductible from income. All right, it does provide him with some kind of a benefit, but it's not deductible from income. We'll talk about the employer side of that eventually, right? Next up is union dues. So union dues are specifically listed in the Income Tax Act as deductible from income, from employment income specifically. So I'm just going to make sure that I fill that in. And we've got over here. Oh, yeah, that's right, eh? We're going to reduce his income by $100. This is actually a deduction, right? It's both a source deduction, it's remitted on his behalf to his labor union, and he can also use that to reduce his income. Good. So once we've gone through the basics here, then I'm going to have to go ahead and get into Mate's other information. So this is usually how these questions work. Here's your taxpayer. Here's some source deductions. Here's some other info. So first up, we've got Apex providing Mate with an automobile to use in his employment duties. When your employer provides you with an automobile, you are looking at whether or not you have a taxable benefit. This isn't a deduction. Anybody who is going to refer to something that's provided by their employer, right, as a potential deduction, unfortunately, that's not the right consideration, right? If the employee is paying something, is it deductible? If the employee receives something, is it taxable? In this case, the employee receives a benefit, which is the use of this automobile. So we have to calculate what's going to be a standby charge and, in all likelihood, an operating cost benefit, because it states that the company does pay operating expenses of $10,250. The operating expenses that the employer actually pays of $10,250 has no impact on this guy's taxes whatsoever. It's just an interesting piece of, or not so interesting piece of information. The benefit to the employee is going to be calculated based on the prescribed rate and the number of personal kilometers that are driven in the year. So we can ignore the $10,250. I don't know if I did make a comment to that extent in my notes, in my footnotes right here. So there you go. Operating costs of $10,250 are irrelevant. They're not taxable, nor are they deductible. So you can leave those things. But we know, let's see, what do we know about the automobile here? It's purchased, used from a dealer for $33,600, including GST of $1,600. That's great. So GST is capitalized as well. It's built into what we have there. That has no impact whatsoever on the calculation of the standby charge, right? And when I say no impact, right, the entire capital cost of this vehicle will be utilized to calculate our standby charge. Okay, so the automobile is available to Mate for all of 2024. That's great, 12 months. Okay, so I'm getting closer to being able to calculate what this guy's benefit is associated with the automobile. Do I have any more info up at the top? Yes, it talks about I got to shrink this down a little bit so it's totally readable. There we go. So 2024, he drove a total of 81,000 kilometers. It's a lot of kilometers, 75,000 of which were used for employment purposes and 6,000 for personal use. This is going to allow us to calculate this guy's standby charge. So let's do that up above here. We've got the standby charge, that calculation that I'm going to make right here. I have, again, pre-populated this. So this is how it's laid out. So we have a standby charge. Now, the first component of this is the standby charge reduction. That is the 6,000. You can see down below, standby charge reduction. That's 6,000 kilometers. That's personal use kilometers over 1667, which is standard. It's a constant that doesn't change, times 12. The 12 represents 12 months. So the maximum that can be is 20,004 as a denominator, and we have the maximum of 20,004 here. So first up, we have our standby charge, 6,000 personal kilometers over 20,004, which is the maximum, times, and this is where we're just multiplying numbers by other numbers, 33,600, which is the cost of the car, times 2%, which is a constant, and then 12 months. That'll give us our standby charge of, oh no, I didn't pre-calculate this, so you guys can sit there while I type out some incredibly complicated standby charge here. It turns out it's 2,419. I'm actually not going to do a complicated calculation with you, but if you are to multiply all those numbers together, you will find that that's $2,419. We then have to determine what the operating cost benefit is. Now, the operating cost benefit, because the standby charge reduction is applicable here, we have a choice. It's the lower of two numbers. It's going to be the lesser of two things. The operating cost benefit is going to be the lesser of basically it would otherwise be determined to be, which is the 6,000 personal use kilometers driven times 33 cents. The 33 cents is a variable. It's a prescribed rate, and that is the rate for 2024, which is the tax year that we're being instructed on here and tested on. So 2024. If you're watching this in the future, the only thing that'll change here potentially is that this rate, standby charge, or the operating cost benefit prescribed rate might change. It'll, in all likelihood, be somewhat higher if you're watching this at some point in the future. But everything else here, unless some major changes have happened to the Income Tax Act, is probably still applicable. So the second term in the lesser of values here is the 1/2 times the standby charge. So basically just take whatever standby charge that you would have calculated, which is 2,419, and look at half of that. The lesser of those two things is the one you want to choose, because remember, this is an income inclusion. A taxable benefit is an income inclusion. We want those to be as small as possible. So if we have the option to choose between two numbers, we want to take the smaller one. So the first one, if you do the math on it, is 1980. And the second one, if we do the math on it, is 1209. And guess what? The lower of those two things is 1209. That increases this guy's income. So the standby charge, again, is a benefit, increases the income. We have a operating cost benefit as well, which again will increase his income. And then we can move on. That's all we need to know about the automobile. We can move on to our next little piece here, which is point 2. Over to our right, Matei earned the Outstanding Employee Award for 2024. Besides a plaque, a plaque. The award comes with a check for $2,000 that's paid in January 2025. And so, I mean, I'm sure most people are looking at that saying, hey, it's money. If you get money from your employer, of course, you have to include that in your income. But take a look here. Despite the fact that he earned it in 2024, it was paid in 2025. For employment income, we only include amounts that we've actually received in the year. Given the fact that this guy doesn't receive this in 2024, oh no, we don't include it in his income, which is probably good, I guess. Lower income means lower taxes, right? So employment income is always determined on a cash basis, and so we don't include anything in relation to the $2,000. Next up, we have point 3, which is Matei is granted an option to buy 1,000 of the company's shares for $35 a share. So that's how much he can pay for them. So we're going to have a stock option benefit here, potentially, right? If this guy is able to purchase shares at a price that is lower than whatever the market can sell them for, then yeah, there's a benefit that we have to determine and include in his income. So we've got $35 a share, maximum 1,000 shares. Option price is higher than the estimated fair market value of the company's shares at the time The options were granted, which means they would be out of the money for those of you keeping track on that. Interesting, not interesting? I don't really know here. What is important to note is that what kind of business is this, right? And I probably didn't make note of this earlier on, but I'll do so now. And I will say, going back there, this is, in fact, Apex Retailers is a CCPC. Okay, given the fact that it's a CCPC, there are certain stipulations and tax breaks regarding the inclusion of income. So that is worth noting as we continue on with the narrative of the question here. So we continue back in. So let's see. What did he do with these options? On July the 15th, he exercised the options, which means he purchased the shares. At that point, we have to quantify if there's a benefit to this guy, right? So he purchased the fair market value is 48 bucks a share. Great. So if he bought them for 35, but the fair market value is 48, that means 13 bucks a share is his employment income benefit. We need to determine that. Now, what I need to know is when am I including that in income? Because it's a CCPC, you can generally defer that inclusion until the time of sale. Looks like he immediately sold the shares for 48 bucks. Ergo, we must quantify and include the employment income benefit now. Okay. I'm not going to worry about any kind of taxable capital gain. There isn't one. Okay, there's just an employment income inclusion because he bought them and sold them immediately. So we're just going to quantify what the CCPC stock option um, benefit is here. So I think I kind of went ahead and did some of this already. There it is. We got a stocks option benefit, right? This was these shares, as stated, were out of the money at grant date. We got 1,000 shares times 13 bucks a share, which is 48 minus 35. And if we do the math on that, I can times that by 1,000. I can times 13 by 1,000. Guess what? It's $13,000. So there's your 13 grand. And that's a benefit. It's an employment income inclusion. Yeah, this guy has a benefit because he got to buy stuff for cheaper than um, everybody else could potentially buy it. So this is nice for this individual. I mean, look what happened. He spent $35,000 on shares and then he sold them for $48,000. So he basically just made 13,000 bucks from doing nothing, right? Does it make sense that he has to pay tax on that? Yeah, it does, right? So he's got $13,000 in cash. Let's keep this in mind. In cash, he's got $13,000. All he has to do is pay tax on the 13, right? Which I think makes sense. Does it not? You can't get money for nothing, guys. So by virtue of the fact that this guy's employed, and again, I mean, he did nothing else here. He got 13,000 bucks and he's going to pay whatever his marginal rate is on this thing, or his effective rate, I should say. So who knows? Maybe it's 30% or something like that. So maybe this guy pays, I don't know, 4 grand in tax. He did nothing. So I don't know. I think it's a good deal. You can decide for yourself. So that was point three. Point four is one of the reasons Matei has stayed with Apex is the employee provided free daycare in a facility located on Apex's property. It's not available to the public. He has 2 sets of twins, age 2 and 4. He estimates that he would have had to pay an annual minimum of 8,500 bucks per child for equivalent daycare if it were not for the employer facility. So what we're considering here is, hey, this guy got something by virtue of the fact that he was employed by Apex, right? He totally did. He got a bunch of daycare for free. So if you want to, extrapolate that out, 8,500 bucks per kid, what is that? 17, 34,000 bucks. And the question here is, do I have to quantify that and include that in his income? Is he getting a benefit? So if this were daycare that wasn't specifically provided by the employer on their premises, then yeah, guess what? There's a benefit associated with this because they're effectively paying $34,000 a year. But there's a specific stipulation in the act that says if the employer is providing this daycare and it is on site, so the kids are on site of the actual employer's workplace, then guess what? Guess what? This is non-taxable benefit. So this is a pretty sweet deal. This guy's getting 34 grand worth of daycare for free. I love it. And he doesn't have to include it in his income. So that's nice. We all want to maximize, right, our non-taxable benefits to the extent that we can. I think I've addressed it down here, which is daycare provided by the employer on the employer's property is not a taxable benefit, which is exciting for Matei here because he just saved himself a ton of money. Kids, I hear, cost a lot. Okay, so point five here, Apex offers its employees a 20% discount on full price merchandise and all of its stores. Matei purchased $2,800 worth of merchandise in 2024 and received discounts totaling 560 bucks. The discounted price of the merchandise was greater than its cost to the company. So The question here is, again, does this guy have a benefit? He's able to buy stuff like we saw with stocks. If you're able to buy stocks for cheaper than everybody else can, there's a benefit associated with that. Now, with merchandise, it works kind of similar, but also kind of different. So with merchandise, the discount on merchandise here that he's getting isn't a taxable benefit because it doesn't go lower than the cost to the actual company. If they had provided a discount to Mate that was lower than what they actually paid for the merchandise, then yeah, there's a benefit associated with that. But in this case, because they're not offering it below cost, there's no benefit. So again, this guy's getting a discount. Great. He's paying less than what everybody else would pay, but not as much as the company paid. So there is a benefit associated with that. This is, again, another non-taxable benefit for our buddy Mate. Point 6, Apex provides Mate with the following additional benefits. Takeout meals eaten while working infrequently required, overtime, $1,200. So normally, if your employer feeds you, normally we quantify that value and we include it in income. Don't you multiply it by 50%? What are you talking about? No, you don't. If you receive something, you don't automatically multiply it by 50%. The 50% comes in when we're paying for food. Did Mate pay for anything here? No, then stop yelling 50% at me. Okay, you pay for meals that are required for you to be consumed by your employer. Okay, you can deduct half of that because some of it is a benefit to you, or some of it is, you're getting some caloric intake out of it. So you can deduct some, but not all, right? You can only deduct half. That's not the case here. He got food. Okay. So normally you'd have to quantify this included in income, but there is again a specific carve out in the Income Tax Act for overtime meals that are infrequent in nature. And you have to work, I think, 2 or 3 hours a night in order to be able to receive a free meal. And it can't be like on a day-to-day basis. It has to be something that is infrequent. And given that that is the case here, oh yeah, I think it's 2 hours. So infrequent overtime meals, not taxable benefit if the overtime worked is more than 2 hours. It doesn't say it's more than 2 hours here. You go ahead and state that assumption. We want to argue on behalf of our client here. So we're going to say that that is not, in fact, anything that is taxable. Next up is the employer portion of the private health services, right? And they've paid $1,800 in insurance premiums over the year. That is listed as a non-taxable benefit in the Income Tax Act. So, this is private healthcare premiums, not a taxable benefit. I should say employer portion of private healthcare premiums are not a taxable benefit. Again, he gets some stuff here. There's value associated with this for sure. $1,800 of value, doesn't have to pay tax on it, right? Next up, personal fitness trainer fees in the company wellness center, $700. Basically, the company just paid a personal trainer to like get this guy more, jacked. Whose benefit is that to? Is it to Apex? I doubt it. The benefit here is primarily to our employee, and given that fact, we have to quantify the value and we have to include it in this guy's income as a taxable benefit. So personal trainer, check. $700 in income, check. Still a good deal because all he has to do is pay tax on $700, which, as we said before, maybe is 30%. So he pays $210 for the use of a personal trainer for the entire year. I would take that deal. I could use it. Yes. Yes. All right. Now we have our final point. This is a fun one. Mate was required by Apex to use a tablet to fulfill his employment duties. He's free to choose whatever tablet he wanted to use. Apex would reimburse him the full cost, but it would be considered property of the employer. In 2024, he purchased an iPad Pro. All right. For whatever money it cost, a wireless printer for $450 and some ink cartridges and paper. So the tablet and printer were used exclusively for employment purposes. All right. Mate is required by his contract of employment to acquire and pay for the cost of supplies he used in the performance of his employment duties. The employer provides him with a signed T2200 form. Okay, so there's 3 numbers to consider here. First up is the iPad Pro. All right, so what does it say here? It says Apex would reimburse him the full cost for the tablet. It's specifically referring to the tablet. So what happens is this guy goes out, he spends $1,700 on a tablet, and the company pays him back. Is there an income tax impact of that? Absolutely not. It's also the company's property, so he doesn't get any benefit from this. There's no benefit associated with it, and there's no deduction associated with it because he's not out any money. He paid $1,775. The company paid him right back immediately. Nothing. Okay. So we don't do anything with the actual with the tablet itself. Next up, we want to consider the printer. Now, the printer is capital property. He had to go out and buy this thing. Now, my understanding is it talks about the full cost being reimbursed by the tablet, but not the printer. So what happens is this guy spent 450 bucks on a printer, and the printer he's just keeping at home. All right. The question is, can he deduct it? And the answer is no. The work didn't require him to buy a printer. He just bought one. Okay. And even if they did require him to buy a printer, it's a capital asset. It's not deductible by an employee. Employees can deduct, take CCA in respect of possibly three types of capital assets if they're required to purchase them by their employer: automobiles, aircraft, and musical instruments. This is none of those things. It's a printer. So basically, he just spent 450 bucks on a printer. It doesn't affect his income. It's a personal purchase, period. I think. No, I don't think. I know, right? I don't think you know either. Smart. So printer's capital asset can't be deducted. And finally, we have the ink cartridges. That falls under supplies in the ITA. It's 81I, I want to say, that if your employer requires you to incur the cost of supplies, you can shoehorn in, you can, fiddle around with the definition of what a supply is, and you can include ink and printer cartridges and stuff like that. Those things aren't capital assets. They'll be used up certainly within a year. So the computer supplies, you can, in fact, deduct because they were required by the employer in a contract of employment to incur that cost. So we have my computer supplies. I'm going to type in the minus 550. Your final employment income for this gentleman is 136,678. I think that coincides with what you see in your textbook solution to this, but if it's not, I don't know. Call and complain to the Camosun College Dean of Complaints Department. I think that's right. I think I did yeah, so I think that's all for this one. I don't think I have anything else to add. I don't know. Please please don't subscribe. I'll add that in. You don't want to do that and ruin your algorithms, and I don't care. Bye. Hey guys, thanks for watching this video. Did you find it helpful? Well, there's plenty more videos for you. Check these ones out right up here. And if you really found this helpful and you want to be updated of all the latest videos, why not hit subscribe? It's that button right over there. Check it out, guys. See you next time.